Guys, we're going to talk about agency financing today, and the goal is to really kind of kill the curiosity and the misconceptions when it comes to Fannie Mae and Freddie Mac real estate loans. So, most real estate investors think that once they find a deal, the bank is just going to fund it, right? Well, that's not really how agency financing works. In fact, deals don't get rejected because of the property, they get rejected because of the borrower. Now, in today's episode, I'm going to break down exactly how to qualify for an agency loan, what lenders are looking at, and how to best position yourself to get approved for agency financing. So, you may be wondering to yourself, what exactly is agency financing? Agency financing, simply put, is a government sponsored enterprise, what we call a GSE, right? And GSE really is Fannie Mae and Freddie Mac. I'm sure you've heard those terms out in the marketplace. They are quasi government organizations. They're government backed. They kind of operate independently, but they receive government money and they have a marching order. They have a mandate to provide liquidity for multifamily housing. Now, if you want to scale into real multifamily, this is the cheapest, most powerful debt option in the game. And there's several key benefits why it's the most important. Number one, it's non-recourse. So that means loans are not personally guaranteed by the individual sponsor. You still can become liable if you do some bad things, which we can talk about in a different video. But generally speaking, your personal assets are not at stake. The second big benefit is that it's long-term debt, usually 5 to 10 years, right? And the interest rates in these deals are typically lower than most bridge loans and other types of debt products out there. And finally, the loans are assumable, right? So that's a huge benefit as you're selling properties, especially if you come into a deal that's got really low leverage or low interest rates, you can market it as an assumable loan. So there's really kind of five core qualification, we'll call them buckets, that you need to be aware of when trying to qualify for agency financing, right? Because agency lenders, remember this, they underwrite two things. They underwrite the deal and they underwrite the people behind the deal. So number one is what we call the net worth requirement. Now that's typically equal to the loan amount. And if you're borrowing $10 million, they want to see a net worth of at least $10 million across the sponsorship group, right? And that's important because if you got five people on your sponsorship team, you're each worth $2 million. Guess what? You can qualify for that. So that's a huge benefit that a lot of people don't understand, right? The other thing is the next option is the liquidity requirements. And so usually that means 9 to 12 months of debt service. I will usually like to say it's 10% of the loan amount. This is where most investors get stuck, right? Not net worth, but liquidity. You have to actually have cash or stocks, cash equivalent assets, not real estate equity. That doesn't count. Cash in the bank, right? And again, can be across the sponsorship team, not necessarily just one person. Now, the third bucket is the experience bucket, right? The track record. This is where, especially recently, in recent years, Fannie Mae and Freddie Mac have been requiring kind of newer sponsors to bring in some more experienced people to help them execute. And that's because they want to have that track record person as part of their team. So prior multifamily ownership is huge because they're not betting on your spreadsheet. They're betting on your ability to execute. Now, how do you solve for this if you're brand new? Well, a couple of ways. Number one, you bring in an experienced KP. This is actually what we do in multifamily dealmakers all the time. We provide KPs to our new members who are trying to execute on their first multifamily deal. You bring in an experienced KP, you give them a little bit of the GP, and now you can qualify for the loan. The next thing is you can start a little bit smaller, right? Go for a bridge loan at first. You don't necessarily have to swing for the fences and get an agency loan off the bat. You can get your experience through a bridge loan. Once that bridge loan closes, you can then refinance into an agency loan and get your experience that way, right? Number four is you can't have any credit or background issues, right? So no bankruptcies, no fraud claims, no bad lawsuits, right? Agency debt is institutional money. So they don't really tolerate risks in the sponsor. Number five, the deal itself. So this is where people really overfocus because you have to have a certain what we call DSCR ratio. What does that stand for? Debt service coverage ratio. Typically 1.25%. The occupancy is usually 90% or higher, and you need to have it be occupied for at least 90 days. Ironically, this is the easiest part to fix, right? The sponsor is the hardest part. You can fix the management, right? You can find deals that have that actual occupancy requirement, but if you can't, if your sponsor has some certain issues in their past that they can't, get around, then that's going to be tough. Now, let's talk about what lenders actually care about. Okay. And this is really based on my experience working with agency lenders for over a decade, right? And understanding their risk tolerance, representing them on the borrower side, the lender side. And it's this, right? Here's what people are not going to say, lenders are not going to say publicly. The execution risk is greater than the market risk. And then sponsor cohesion really matters, right? So who is making decisions? The management structure of the operating agreement needs to be very clear. And we need to have a certain manager, and usually it's the most experienced person is managing the business. Managing is the manager under the operating agreement. And conservative underwriting wins approvals all the time, right? The business plan must be believable, right? You can't have aggressive deals. Aggressive deals do not get agency debt, right? Proven operators get agency debt, but deals typically do not, right? So let's talk about why most people don't qualify for agency financing. Okay. First mistake is they're trying to do it solo. Agency lending is a team sport. Real estate investing is a team sport. If you're going for an agency loan, make sure you have your team in place, right? Second mistake, overestimating their financial position, right? Equity in your house doesn't help here. You can't fluff up your personal financial statement. The bank will go and ask for bank statements and deeds and operating agreements to prove what you tell them on your personal financial statement. Okay. Now, also the next mistake, third mistake is there's no relationships, right? So you don't find agency lenders on Google and win. You've got to network with mortgage brokers. Now, most big real estate broker shops, Marcus and Millichap, GRIA, Cushman and Wakefield, JLL, CBRE, they also have an agency lending arm. Okay. Now you may wonder, what is an agency lending arm? So when companies want to become agency lenders, they're what you call a DUS lender. That stands for Designated Underwriting and Servicing. Okay, what does that mean? That means that the lenders are designated by the GSE, by the government sponsored enterprise, to make loans, but it's not actually their money. So we do a lot of our agency lending with CBRE. CBRE is our lender for all intents and purposes, but it's backed by Fannie Mae and Freddie Mac. So when we close a $5 million loan with Freddie Mac, with CBRE, Freddie Mac closes it, but Fannie Mae will actually fund it at closing. And then CBRE, I think, puts in 10% of the loan proceeds, and then they end up assigning the loan over to Freddie Mac, right? So that's what designated underwriting and servicing means. So if you're working on larger multifamily deals, now the mom and pop multifamily brokers, they're not going to have a DUS lending arm. You need to go to a national multifamily broker shop. And most of those big broker shops are going to have the DUS lending arm. So what that means is you keep it all in house. So you go and you get a deal from Marcus and Millichap. You ask them, hey, do you have a DUS lender? You can introduce us. And then boom, there you go. But you're not going to Google it and just call up Arbor or multifamily lending, 1-800 number and ask them for a loan. It's usually through personal relationships. So the next mistake, I think we're on number 4, is jumping in too big, too fast, right? Your first deal probably isn't going to be a $20 million agency loan, right? So start small. And there's also something called SBL, small balance loans. Now, these are loans that the agencies have geared up to solve for a problem of smaller properties. And they're really good. The closing is typically a bit easier in those deals because they're less hoops to jump through, legally speaking. SBL loans are still a great way to get into the game, to get into smaller properties. I think the minimum loan amount is $1 million. They may have increased that recently. I need to double check that. But that is also another program to take advantage of. So let's talk about this. Let's talk about how to structure your way into an agency loan. This is where you're going to differentiate yourself. Okay. So you're listening to this. I want you to listen up. Number 1 is the key principal structure, right? Remember that you don't need to qualify personally. You need to assemble a team that qualifies. Okay. So if you don't know any KPs, join a program like Multifamily Dealmakers, join a million other programs out there where you can find and network with these other KPs to then offer them a seat at the table and qualify for the loan. Right. Second strategy we talked about a minute ago is starting with a bridge. And you can refi into an agency, right? Because when you're getting a bridge loan, it's typically a deal that is a little bit more hairy, right? I looked at a property today that is going to be a huge bridge loan. Probably it's a $12 million all-in project cost, and but it's not agency because it's like probably 25% occupied, right? Big distressed deal, but that's where real money is made. But we could not go to agency for that. We'd have to go to a bridge lender, right? And that's just the name of the game. So you pay a little bit higher interest rate on bridge loans, and but then once you get that to that 90% occupied for 90 days, that is when you can refinance into an agency loan, right? The third strategy is kind of the co-GP model, right? So you bring value in the way of a deal team, a capital team, an asset management team, and then earn your way into the GP. So for those listening that want to get on one of these teams where you're going to go buy a deal and agency lending is on the deal. If you're the lead sponsor, you found the deal, then you got to bring in a KP. If you're trying to hustle your way into this business and learn how to, and you're going to try to get into your first multifamily deal, then offer some value. Offer some value to the GP team. Offer to asset management. Offer to go cut the grass. Offer to do some stuff for free. You've got to be able to provide that value first and then get a seat at the table, and then you earn your way up after that. So here, I'm going to give you some insight here. Here's a roadmap to qualify for an agency loan. And again, this is based on my years of experience as a lawyer, as borrower's counsel, as lender's counsel. This is what you need to do to qualify for agency loans. So number one, you've got to build your balance sheet. Liquidity matters. It matters. So have some liquidity available. Partner with some people that have the liquidity available. You want to be able to show that, have it in the bank account. You want to be able to have that as part of your balance sheet when you approach any lender, right? You also want to get around experienced operators, right? Get on their teams, learn from them, but keep underwriting deals consistently, okay? You also need to build your broker relationships, right? Everything goes through brokers, right? As much as we love and hate brokers, everything goes through brokers. The next thing is, you need to, in addition to building your broker relationship, you're going to partner with someone. So get in the right rooms where you can meet other sponsors, other investors, other people aspiring to become a real estate investor, a multifamily investor, right? Because you don't go from zero to agency borrower overnight. You have to stack the credibility throughout this entire process. Okay. So if you're serious about getting into multifamily and actually qualifying for these types of loans, I break this down step by step inside my community and also on our podcast. So if this helped, I want you to subscribe to this, share it with someone who's trying to break into multifamily. If you're listening to this on your podcast streaming, I want you to like it and share this with someone who needs to hear it. Because guys, this is literally not only my personal practice as a borrower. I mean, I'm an agency borrower, but also an agency lender, representing lenders and borrowers in my law practice. So I've seen both sides of this. I've seen, and I'll give you a little inside baseball here. When you go and apply for an agency loan, they're going to run a background check, and that background check may come up with, let's say there's a lawsuit. We had one recently where one of our investors, it was a tenant in common. He was investing a bunch of money, but he had this crazy fraud lawsuit from his father, actually, and it could have been a law school exam test because the father was on his deathbed, signed these documents, and they were claiming that the documents were invalid because he didn't have capacity and whatnot. Long story short, they claimed fraud. And so one of our investors, he was trying to, he had to qualify and get all his ducks in a row for the agency financing. And so what you have to do at that point is you have to write a letter of explanation. You have to explain what happened. And typically, 9 times out of 10, the explanation will work and they'll rubber stamp it anyway. But if it's pretty serious or you've got some bankruptcies on your record and you've got some other blemishes, they may not be take so kindly. So, anyway, I wanted to tell that little bit of a war story. But seriously, if this helps you, please subscribe to the channel. Please hit that like and share button if you're listening to this on Spotify. And anyone has any questions about this, please reach out and I will look forward to seeing you guys on the other side. Thanks.